Welcome back, investors, to Ticker Time News. I'm Adam, and fears that Disney would follow in the footsteps of Netflix and deliver weak Disney Plus subscriber growth didn't happen. But the company's overall Q2 results were far from magical. The much better than expected addition of 7.9 million Disney Plus subscribers is definitely the main highlight of a quarterly report that came up short of EPS and revenue expectations. While investors had in previous quarters focused solely on subscriber growth, the cost of acquiring these new subscribers is now also under the microscope as profitability is emphasized instead of growth. While using profitability as a measure, Disney's direct-to-consumer business looks much less impressive. It posted an operating loss that increased by $600 million year over year, losing $900 million in the process. Rising programming, production, marketing, and technology costs more than offset the 23% increase in direct-to-consumer revenue of $4.9 billion. That growth was driven by a 29% jump in subscriptions across all streaming platforms. That includes Disney Plus, ESPN Plus, and Hulu. Higher costs are only half the equation, though. After drilling down a bit further on Disney Plus subscriber gains, you will see that 4.2 million of the additions from Q1 were from Hotstar. Average monthly revenue per paid subscriber for this India branded version of Disney Plus is just 76 cents compared to $6.32 in the US. This metric clearly illustrates that not all subscription additions are equal, stoking another concern. While it was encouraging that Disney's CEO reiterated that Disney remains on track to reach 230 to 260 million Disney Plus subscribers by fiscal year 24. The path to attaining that goal will likely lead to even larger direct-to-consumer operating losses. That's because the company plans to heavily lean on international growth to expand its user base, including through its lower-priced Hotstar platform. During the earnings call, Disney's CEO stated that Disney Plus will launch in 53 new markets by the end of this year, while Disney produces about 500 shows in local languages around the world. Therefore, I anticipate that subscriber additions for Disney Plus will continue to rise, and sharply, though at a significant cost to the bottom line. Meanwhile, Disney's Parks, Experiences, and Products segment experienced a 109% year-over-year surge in revenue to $6.7 billion, fueling a $2.2 billion year-over-year increase in operating income to $1.8 billion. A few key highlights and issues from this more traditional business are these. 1. Growth was primarily driven by the domestic theme parks, which were open for the entirety of Q2. In the year earlier period, Walt Disney World was open, but Disneyland was closed for the entire quarter. Disney's CEO characterized the domestic theme park business as firing on all cylinders, and it's hard to disagree. Per capita spending at the parks was up by more than 40% compared to 2019 levels. That's pre-pandemic. Additionally, there were many days during the quarter in which demand exceeded 2019 levels. Now that's awesome. There's no slowdown in sight as the demand pipeline remains robust for Q3. And 2, performance for Disney's international parks was mixed as COVID-19 factored into results once again. Specifically, Hong Kong Disney was closed for the first 3 weeks of the quarter, and Shanghai Disney has been closed quarter to date. On the positive side, Disneyland Paris is generating strong yield growth and continues to recover towards pre-pandemic levels. The outlook for Q3 isn't great though, as Disney expects that closures at its Asia theme parks could adversely impact operating income by as much as $350 million versus last year. This is on top of the $150 to $200 million projected decrease related to anticipated declines in content licensing and an ongoing decline in home entertainment results. Overall, Disney's results were a mixed bag. The solid subscriber gains for Disney Plus are certainly a relief, and the stunning comeback for the US theme parks business is a huge positive. However, mounting losses within the direct-to-consumer segment are concerning given the heightened focus on profitability in this market environment. Disney hit a new 52-week low last week and fell below the $100 a share price point for the first time since April of 2020. What do you think about Disney's future? Could Disney become the new streaming king, overtaking Netflix? Let me know in the comments below, as your comments help us all to better understand. Help us out by smashing that like button, sharing this video, and join us in beating this crazy market by clicking the first link in the description. I'd love to see you there. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.